Hey, and welcome to Tax Tuesday with the Tax Queen. I am the Tax Queen, also known as Heather Ryan, and I am here to support digital nomads, RVers, travelers, business owners, you name it, with their taxes, tax issues, tax planning, tax strategy, tax prep. So today I do Tax Tuesday, right, is the first Tuesday of every month, and I get questions that are submitted ahead of time, and those are what I will answer first. If you're here live, feel free to drop in the chat where you're joining us from, and good morning. I'm happy to have you here. Like I said, I'm going to go through the questions that I got prior to going live. So anything that's submitted in advance. And then if I have some time, I'm happy to go into some live questions if you have them. I only have a few questions ahead of time, but I'm going to dive right in. So, first question. My partner and I work for the same company as independent contractors. So I'm going to stop right there because you don't work for a company. If you're an independent contractor, you work for yourself. Independent contractors, that's exactly what they are. They're a contractor and you own your own business. So you have to track your own expenses. So that's a first correction there. Um, and we sometimes travel for work. Do we need to split these travel expenses 50-50, or can one of us claim the receipts from trip one and the other? So I really can't answer that. As partners or whatever traveling together, I'm not really sure, I work with all kinds of travelers. So there's travelers in an RV, there's travelers that are flying and staying in Airbnbs. Um, yeah, so without really knowing the specifics, I can't really answer that. But generally speaking, travel expenses are to duplicate your living expenses. So is that what's happening there? I don't know. Again, I can't really answer that question because it's a very open-ended, we'll say. But yeah, travel expenses are based on duplicating living expenses. So generally, if you live in an RV full time, that's your lifestyle choice, and you do not take any expenses for moving the RV, right? That's your home. You're just moving your home. If you fly, get on a plane and fly, stay somewhere in a hotel, Airbnb, I don't care, use an Uber, that type of thing. That's duplicating your living expenses because you're leaving the RV behind, and now you have, right, double expense. The same thing for mileage. So if you get in your car and you drive 100 miles, 500 miles to attend a conference or to work with a client, that mileage would count, but not moving the RV. So the same thing kind of applies as a digital nomad. Again, I don't know this person's situation, so I'm just going to go and explain kind of both. So digital nomad, right? You're probably flying or you're taking the train or whatever modes of transportation to move from place to place, and you spend a little bit of time in each place. Those don't count for business expenses ever. So again, I'm not really sure, and I'd love if this person was here to clarify what exactly how they travel. I am going to drop this link in there. So that's just general business expenses that you can take. Again, you don't work for a company if you're an independent contractor. You work for your own company, and that other company, right, you're doing work for is that, right? They're paying you to do the work, but not as a wage earner, not as a salary. So you have your own business. Okay. Um, and then this funny, I get a couple of questions this time around about travel expenses. So I'm gonna dump a link for the travel expenses in here as well. So you can look at both of those. So that the travel expenses one will kind of explain a little bit. I was talking about duplicating living and costs and living expenses and leaving the RV behind, leaving your general home, right? Your main home behind. And sometimes that means leaving a family members, partners, or whatever. So, okay. There are a couple of questions related to that, though. I remember reading these before. So, anyway, question number two. I started consulting as a sole proprietor. Great. My current state of residency is in Minnesota. However, later this year, I plan to establish residency in Nevada. I also intend to create an LLC and move the consulting to the LLC. Since all of this will occur within 2025, can the income as a sole proprietor go under an LLC for the entire tax year? So I am here to tell you LLC makes no difference. I don't care. The IRS doesn't care. You are sole proprietor all year long. The LLC is kind of ignored for tax purposes. And this is a big misconception with LLCs. And I'm going to drop one more link in here all about LLCs. Everyone thinks they magically form, not magically, you form an LLC, right? You form it with what? The state that you're going to or that you're going to live in or perform work in. Um, it doesn't do anything. It's a legal entity with the state. It's not a tax entity. So a single member, right? You're one person, you're sole proprietor, you're forming an LLC, you're still a sole proprietor for tax purposes. Changes nothing. And so in this case, doesn't change a thing. There's no extra things to think about, except maybe the filing fee for the LLC that you get to take. But a sole proprietor, Schedule C, doesn't matter whether it's an LLC or not. Single member LLC equals sole proprietor. So again, the question goes on, well, I need to file two separate companies as a sole proprietor and then under the LLC. So again, same thing. They're the same exact thing. No change. I think it's great. You're changing. You're moving to Nevada, which is no income tax state. Great. And yeah, but doesn't make any difference for tax purposes. And it's funny how I get questions that are sort of all like related. Funny enough, when I do these, I feel like a lot of times, they're all kind of either centered around one topic. So in this case, we're talking about um, LLCs and being contract worker, independent, a freelancer, whatever terms you want to use, right? We're being a sole proprietor and a business owner, talking a little bit about travel expenses. So just funny how that works. Yeah. All right. Third question. We're full-time reviewers with a winter home based in Arizona. We do seasonal work in various states. Up to now, we've been married filing jointly, as we have both had the same domicile and similar W-2s. An income tax, if we've worked in an income tax state, I submit a part-time residency. So I'm going to stop here. I like to stop the minute I see something that's kind of odd to me. So if you work in a state, you don't submit a part-time residency. You are still a non-resident of that state. Unless you've spent, more than 6 months there. So if you spend 2, 3 months work camping somewhere, you're not a resident. You're not even a part-time resident, part-year resident. You're a non-resident with income for that state. So I just want to clarify that. And then let's continue on. However, my spouse now has an Arizona driver's license and did part-time work this winter in Arizona, which received a W-2. Okay. The first question is whether should be considered a year-round Arizona resident for the purposes of a tax return, and this also means that any work done in other states would be considered taxable. All right, so this is getting complex. And I want to step back because I really can't answer this question directly. This is why I work with my clients on an individual basis for their unique situations of working in different states, having different residencies and domiciles. Generally speaking, let's go back to the definition of domicile and we can't really interchange it with residency, but we sort of do as travelers. So domicile is your legal residence, your legal place of your saying, I'm a legal resident, right? I'm picking this state as my domicile. And that usually entails auto insurance, driver's licenses, right to vote, any kind of maybe church affiliations or organizations that you might belong to, fraternal or whatever, doctor's visits, things like that. So we're establishing our ties to that state in that way because we don't have a physical home, right? So when the red flags here, right, again, why I can't really answer this question, I'm just going to give you broad definitions. When you say that my spouse got an Arizona driver's license, so now we're establishing ties to Arizona and that maybe that's our new domicile and our new resident state. So that's why this gets kind of sticky. Um, And I can't really say one way or the other, is that wrong or right? Yeah. So that's kind of, yeah. The other thing about Arizona, is that it's a community property state. So just be aware of that. And some states, so states will basically not consider you a resident a lot of times until you've spent, 183 or more than 6 months in the state. But the minute you start getting that, the driver's license, the insurance, the doctors, spending more time there, right? You're spending, that's like your base, right? Your winter home base. We're adding ties to that state. And so Arizona, in this case, it's Arizona, might say, hey, you were actually a resident. You spend enough time here. You might come to the doctors in the winter. You have a driver's license here. You work here, right? So they might start to say, hey, you're an Arizona resident. Um, so yeah, I can't really give an exact answer to that question. So I wish I could, but that's exactly why I work with my clients one-on-one, because I ask them further questions. I can run scenarios and things, the best options for them. All right, next question. If I own 3 rental properties, an RV, and a house, except I only use the motorhome to travel to the rental properties to do maintenance, repairs, meet with property managers. Are the motorhome expenses deductible for the days that are fully dedicated to business? I would be effectively using my RV for transportation and housing. Okay. So, for example, if the motorhome were used about 90 days in the year and 46 of those are used for business, um, wouldn't 46 out of 90 or 51% of the annual motorhome expenses be deductible? This gets very gray and we really muddy the waters. The IRS to date has not really per permitted RV use, right, for business because it's very cloudy, right? You're telling me that you're driving, I don't know how long, what's the distance, right, from your regular home that you live in and spend time in to your rental properties. I do not know the distance, because that wasn't shared. Um, but you're sleeping, right? You're sleeping, you're watching TV, you're doing personal things in the RV. So generally speaking, I have other people that have a home and that will use an RV for business purposes. Generally speaking, I say just take the mileage to get to the place. If you stay at a campground near the rental properties, that can count, versus staying in a hotel. But I generally shy away from deducting a basically you're talking here about depreciation because that's the biggest thing. Depreciating the RV, I generally stay away from it. It's just a really big red flag to take huge expenses like that. And again, the motorhome, right, you're using it personally too, right? There's a very mixed use. So it's a very gray area. And again, I work with my clients and I kind of will gauge, and suggest like what's your risk, right? Tolerance. Are you okay with raising a red flag? Or do you want to really stay under the radar? And so those are the things that I would talk about and discuss with you. So if you think your risk tolerance is high and you want to take the RV, then that's your choice. Generally, I shy away from it and I would just take the mileage. So hope that helps there. Um, the biggest thing for that is making sure that you have business logs, logs when you're using the RV, the distance, the dates, the purpose, all of that stuff. So you need to have logs, a good mileage log for all use, and then obviously stating the business purpose. So yeah. I hope that's clear. If you have any follow-up questions, if you're on here, I do see a couple of live questions. So that covers what I got previous to showing up live. So I will go ahead and read through some of the questions that are on here. Can all income from the year go under Nevada or part of it be considered Minnesota? Okay, so when you have a split year return, you split your that's exactly what you split. So Nevada doesn't care. There's no state income tax. So there's no filing in Nevada. So it's Minnesota that cares. So if you left Minnesota, I don't know, July or October, right? So if it's July, I just say split it 50-50. Some people actually do track monthly, so you can be very accurate there. But it will be split. It'll be a split year. So you'll be a split year, part year resident of Minnesota, part year resident of Nevada. Nevada has no filing, so bingo, easy. Um, yeah. Did I miss the question about splitting travel expenses? That was the very first question. And I don't again, I really don't have any clarity on that, and so I didn't fully answer the question. And I because I don't know how you're traveling, and generally speaking, travel expenses are not a business deduction. If you're living this lifestyle of RV life, it's there's no travel expense to deduct, right? Um, moving your RV from one place to another is not a business deduction. So I don't, um, yeah. If you're parked at a campground or an RV park and you drive to a business location to meet with a client, that mileage can count, but not moving an RV from one place to another. That does never counts. That's your lifestyle choice. That's what I like to say. The freedom that we get to live and be where we want, work when we want. That's the benefit of the lifestyle. So we don't get to take travel expenses. Travel expenses, uh, yeah. If you fly, and stay in a hotel, then you get to take the expense. You're duplicating your living expense. So that's, I'm not really sure what the question is because yeah, um, yeah. Yeah, no, I did cover this. So if you're staying in hotels and flying, those costs count because you're leaving your home behind. And I don't see any issue with taking those. You're duplicating your living expenses. And again, I shared a link here. I can share it again, but taking travel expenses is all about duplicating living expenses. So yeah, I'll share that link again. Um, Yeah. So it is in the thick of tax season. I have 2 weeks left for the deadline, 2 weeks literally from today, right? The 15th. I think the 15th is a Tuesday. So I am going to hop off unless someone has something else that they wanted to ask here. I thank you all for joining me, and I will see you next time. The next one we're having is May 6th. So I will see you then. Yeah. And feel free to ask questions or submit the questions in advance. Like I said, I always go over those first, and then we will hop into live questions if that's, yeah, if that's here. So you're asking one more question. My partner and I traveled together, so we purchased flights at once, and do we split that? So, okay, I'm going to step back before we even care about travel expenses. If you're each running your own business, right? I don't care if it's whatever, your husband, partner, doesn't matter. Um, you have to track your own expenses. So all of your own income should come into your own business bank account, and all of your own expenses should go out of your business bank account or a business credit card if you want to use that. So if you're buying tickets, you're buying flights, they should be on your own business accounts. And the same thing with hotels, it should always go on a business credit card or business bank account. That's how the expense should be. So I'm not really sure about splitting things because everything should always be separated anyway. I'm a big proponent of keeping really good, clean records. That's the only way you're going to prove anything in the case of an IRS or a state coming back and asking you questions. And I always have separate bank accounts. And so sometimes people say, well, I'm a sole proprietor and I don't have a business bank account. You can have a personal, what we call personal, right? It's deemed personal by the bank, but it's still only used for business. We don't commingle our funds. So every time we get paid from our company, from our contract work, goes into that separate account. So whether it's labeled business or personal, it doesn't matter for the bank purposes, right? I say it's a business account, right? Because that's the only money that's going in or out is business money. When I go and I buy my groceries or I pay my utility bills, it's always coming out of a separate personal account. And so that's what I'm talking about, have really separate things. Because when we have all those separate things, right, those separate bank accounts, separate expenses and everything, we can track them much easier. We're not wondering, oh, was that expense personal? Oh, I went to this restaurant. Was I meeting a client there? That type of thing. We don't have to go back and remember months later. So I really, really stress having separate bank accounts, and all business expenses and income goes into a business only account. So yeah, if you're buying a flight, buy it with the business account or business credit card. I hope that answers that question. Because sometimes the question is actually we need to step back and look at what we're really asking about is expenses. So keeping them separate, really, really important. Um, yeah. So thank you. Thank you for joining me. Again, I'm going to hop off. I do have tax returns to get to. We're 2 weeks from the deadline. And I will see you in May. Have a great rest of April and enjoy maybe some signs of spring wherever you happen to be. And I will see you next time.